The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to today's webinar. My name's Phil Gallagher. I'm the General Manager of Commercial at CCIQ. Joining us today is Michael Judge, Head of Corporate Dealing at Australia's OFX. Welcome, Michael.
Good morning, Phil.
OFX is a new partner with CCIQ and is one of the world's leading global international payment specialists. This webinar is first in the series of webinars with OFX, who will be sharing some of the key themes driving global currency markets and the key considerations for exporters when it comes to optimizing payment routes. In today's webinar, Michael will be discussing the Australian dollar performance in general, and boy, it moved a bit last night, and doing business with both established and developing export destinations. At the Chamber, we do the export documentation services, certificates of origins for over 1,000 businesses, both small and large, and all of them at some stage are having to deal with foreign exchange and currency. So this is an issue that I think is really, really important to a bunch of our members. Also, as a Chamber, one of the key ways that we help our members is by helping them to manage risk. And to me, great strategies and great advice in this area is essential for managing the risk when dealing internationally. But before we start, I just want to ask Michael a question. If you want to ask Michael a question, you can do so at any time during the webinar using the chat box that appears in the bottom right-hand side of the screen. I will now hand over to Michael to take you through today's presentation. The presentation is entitled The Evolving Global Market of Foreign Exchange. Great to hear from you today, Michael. Welcome, and over to you.
Thanks, Phil. I appreciate the opportunity, and of course, a big thank you to CCIQ. We're really excited to have been partnered over the last couple of months. So this is the first of a series of webinars, and of course, by way of introduction, my name is Michael Judge, and it's certainly my role over the next 30 minutes to keep you all somewhat engaged and hopefully entertained along the way as well. But I've been with the business now for 10 years. I did originate from a economics background and have moved across the business, originally within the consumer sector to heading now the corporate business streams both across Australia and New Zealand. Now, a logical starting place outside of my personal introduction is obviously an introduction to OFX. That's something which I will speak to initiate this narrative, if you like, and then from there we'll obviously move into some dialogue around the Australian dollar, secondly the US dollar, and I suppose from there as well some key payment considerations for global businesses who are operating in a global environment. Now, mindful, a lot of our audience today, some of you may have, I suppose, a mixed understanding of what OFX does and where we sit in the marketplace, but essentially we are a mature business. We were founded originally back in 1998, and the key pillars, I suppose, spoke to the fact there was a gap in the market, particularly across the consumer and retail space, where our founding partners essentially were able to identify that the banks in particular weren't providing a great deal of transparency, value, and ultimately the exchange rates on offer really weren't competitive or adding too much value to a customer base. Having moved through a few different forms of ownership over the years, our growth story, if you like, did culminate in us becoming listed on the ASX in 2013, and today, as Phil recognised, we are one of the leading global international payment specialists and definitely Australia's largest non-bank foreign exchange provider. As I touched on, our growth story originated from the consumer brand, and certainly that has been leveraged across a fairly broad customer base, which is represented today. So from the consumer team, it spoke or in fact branched out to the SME and small business sectors into the mid-tier large corporate space, as well as today having an API and enterprise solutions model. Just at a glance, very briefly, a lot of the conversations, a lot of the value that we are trying to push to our customers speak to a lot of these things on the slides. Obviously, currency strategy, risk management tools, dependable services is obviously something which is very important to us, protection and security, and again, ultimately delivering real value and some bottom line improvements in the form of great pricing. Just, I suppose, by way of numbers, we do employ over 300 staff across 7 markets. We essentially do operate in 3 key geographies, being Asia Pacific, North America, and Europe. As I mentioned earlier, we did list in 2013, and today we represent over 1 million customers across the globe. There'll certainly be an opportunity for you to challenge me down the line just in regards to, I suppose, OFX a little bit further on. But I suppose just in changing tack and providing some context. On an almost daily basis, our sales teams and our key account managers, we are actively engaged with our customers. And I suppose our role is not only in delivering exceptional execution in making and receiving payments across multiple jurisdictions and across borders, but I suppose the value of the people who sit at the front line certainly do speak to market insights, ongoing education, and really a whole bunch of knowledge shared along the way. We do have access to a treasury and a research team in-house, so we do play an active role in educating our customers. An education piece, I suppose, which speaks not only to maximising the timings of your payment entries, but I suppose just understanding the broader environment under which we're all influenced and participating in. So with all of that said, I think, but before I get to some of the observations of today, I think it's really important just to provide some context in regards to what's transpired and what has really defined the marketplace over the last 10 years. I'm certainly mindful of, I suppose, speaking in too broad a lens and going too far back into our, I suppose, history books. But with August of 2018 fast approaching, that date will represent a 10-year anniversary since the global financial crisis. Now, we all know and have read a great deal about the GFC. There is an acknowledgement that it was a period of extreme stress, not only across the banking system, but the global financial market. It has irrefutably changed the way that everybody and all market participants have behaved and operated during the decade which has since followed. It was a once-in-a-lifetime event. It's certainly very difficult to see that type of shock reoccurring in the majority of our lifetimes, at least. And as a result, we saw a policy response on a global scale, again, to the extent that we have never witnessed before. Central banks globally, instead of focusing, I suppose, their energies on traditional economic objectives, it spoke simply to recovery and simply to stability efforts. So we saw a mass injection of liquidity. Essentially, central banks across the globe were throwing the kitchen sink to ensure that liquidity was provided, again, to some of the world's deepest, safest, and largest marketplaces. In regards to the impact that had on a lot of the major currency pairs, we looked at today even, the yen, the USD, the sterling, and the euro, and there are only 4, but I think across the board, it is only really over the course of the last 18 to 24 months that a lot of those established pairs are starting to show, I suppose, little spurts of growth. So with all of that said, I think we probably came into a unique juncture and a really big pivot point in regards to the water which has passed under the bridge over the last decade, in that we are now in an environment where monetary settings are starting to normalise. It's a unique juncture, and again, it's unique because not only over the last 10 years have we seen a rapid drop in interest rates, but even before the GFC environment, we still were in a 20 or 30-year time frame under which interest rates were slowly, moving higher. So if we move away from, again, this really abrasive period in our economic history to today, where interest rates and monetary settings are starting to normalise, I think the first point that I really want to make, that I think everybody, whether it be businesses, households, mums and dads, governments, I think all stakeholders who are involved in this narrative, which speaks to higher rates today and well into the future, I think there probably is a general underestimation in regards to the magnitude and the volume of the shift which is about to transpire and really has already started to transpire. So, you know, I've put here that knowing something is about to arrive doesn't mean that we're necessarily well prepared for it. So what this means is, of course, higher rates are coming. And in a couple of slides' time, I think we'll be able to demonstrate what the impact that has had, particularly on the Australian dollar. And I think as higher rates return, one key thing I want to point out is that so will volatility. And that the waters ahead, they are uncharted. And essentially what happens when we start to really push a lot more liquidity out of the system, this will essentially, I suppose, escalate or heighten the level of impact for existing and the remaining participants. What I'll come back to in some latter parts will speak to the fact interest rates will always be referenced as the key thing which all major currencies will oscillate around. If you can get the fundamental medium and longer term view of interest rates correct, generally, again, the underlying currencies will follow suit. Whilst we'll come back to interest rates, I think, you know, we've recognised now interest rates have been low for so long. We're coming out of that general narrative, and I think we've pushed past the post-GFC era, if you like, and we now really are into, I suppose, what we would term the Donald Trump era. And I suppose what comes with Donald Trump is, of course, a high degree of uncertainty. And again, I will speak in later parts in regards to what that means for the greenback. But obviously the key two pillars of all of his dialogue speak to tax reform and, of course, protectionism. I think it's those two key pieces which really will, you know, drive direction and sit front and centre in regards to today and in particular for the rest of 2018. In shifting our focus now to the Australian economy and in particular the Australian dollar, I think this is something which is topical for all importers and for all exporters. And as Phil touched on, certainly some anecdotal evidence from our side is that there probably is a broader underestimation in regards to the underlying role that currency fluctuations play in people's business models. Now, I mentioned earlier, obviously, the key attribute of having high levels of liquidity, that is record low levels of interest rate, is that we have seen volatility levels reach record lows. And I think these graphs best illustrate this. And what these graphs really show is simply the Aussie-US exchange rate over 3 different timeframes. At the top here, we can see over the course of the last 5 years, the Aussie has ranged between highs at just short of 108 and briefly dropped below 70 US cents. But really, if you were to narrow your dial in there to January of 16 up into today, so over the course of a 2.5 year time frame, we have only seen a 10-cent trading range for the Aussie-US cross. Now, again, that is almost unheard of. If we push those timeframes into a 12-month window, and again, those ranges have solidified even further between 81 on the top and 73 on the bottom. And still, over the next 30-day window, there is this broader perception that there is a high degree of comfortability around that 75 to 78 US cents mark. So with interest rates have come absolute stability. And even this morning, I think there is a general acknowledgement that volatility is really starting to arrive. I think A headline I read this morning spoke to the fact that the bad days of 2018 have already been really bad days, in that the narrative around low interest rates essentially means that you'll see alignment when things appreciate, but you'll see a misalignment or a desinking, if you like, as liquidity comes out of the marketplace. So with all of that said, I think at a very top level, again, the view for the Australian dollar is for the time being that I suppose the soft-if undertone is here to stay. There's a lot of information now in the market. There is a lot of noise in the market, and essentially from a forecasting or outlooking perspective, that's certainly not our specialty. But again, the role that we play is basically just to provide customers with some context, provide some narrative, and again, just help them better understand the environment under which I suppose they're operating, and also the key little nooks or announcements which may well, I suppose, see a Australian dollar valuation deviate from its current state. Something, again, which is topical to us all, and again, I've pointed out 4 key pillars here, and I won't speak to them all extremely intimately because some of you might fall asleep, but the 4 pillars of what drives our outlook really do speak to the macroeconomic credentials within Australia, offshore quantitative easing measures, and again, that's an acknowledgement that the Australian dollar value is always relative in regards to what it is weighted or paired against. Of course, commodity prices, and again, interest rates, both across the United States and Australia. And again, I will go for a little bit of a deep dive there very, very briefly. Just firstly, on the macroeconomic side, I suppose, we live in an environment here in Australia where our policymakers are relatively conservative. Now, we have high levels of debt at a household level. We have a high degree of linkages to our, I suppose, underlying property market as well. And as a result, there has been a broader reluctance, or I suppose some very cautious overtones delivered by the RBA, I suppose, really observed by the fact we now have remained on hold at 1.5% cash rate for 20 consecutive months. And certainly that neutralised bias is due to remain intact well into the back half of this year. From a growth perspective as well, I suppose on a quarterly basis, we are only trotting along at around a 0.7 to 0.8% baseline, with GDP on an annualised figure around 2.5%. So I think all of the tones when we look at inflation, interest rates and unemployment, all of these macro indicators, they don't necessarily point to a good or a bad. Basically, they sit at somewhere in between, in that things, I suppose, are conservatively okay, but certainly far from being great. And this is obviously supportive of our currency outlook, which remains, again, neutral, with some risk slanted towards further, albeit limited, downside. I really, I suppose, should make the point in regards to the fact that, we are a deliverable foreign exchange payment business. We deliver payment in the form of, I suppose, great people, exceptionally functional technology, and a scalable payment engine which allows us to make payments efficiently and in a cost-efficient manner. When we speak to market trends and we speak to the environment of today, as I said, it doesn't constitute advice. It is simply a viewpoint, which again is part of an open dialogue and a transparent knowledge piece with our customers. I mentioned earlier that obviously interest rates is something which impacts everybody. I probably can't overstate the importance of the US and AU interest rate story. We have 2 graphs here, which the first one is the 10-year government yield curve between both the Australian dollar, or essentially Australia as a country, and the United States. And for the first time ever, we witnessed towards the back end of last year, we actually saw US interest rates outpace that of what is on offer here in Australia. So again, this is a historic event. The US Federal Reserve is almost on autopilot in terms of its mandate to hand down additional interest rate increases. We already have priced in at least 3 additional rises from the US Federal Reserve this year. So the gap between yields on offer in the world's largest economy compared to what is on offer in Australia is only going to continue to grow. So from a currency perspective, what that means is the appetite at a global level for investors to be buying the Australian dollar is no longer there. It means that on a global level, everybody can essentially buy the US dollar and they can enjoy high yields as a result. So this means people, for example, are now favouring the US dollar from a carry perspective, whereby investors can essentially sell the Australian dollar, borrow at a lower cost, and enjoy the high yields on offer available in the US. And again, that equation is supported by 2-year government yields, and you can see the crossover has also transpired at a similar time. In moving past interest rates, and again, if you have any questions in regards to that interest rate narrative, I'm happy to speak to that at the end of today's session. But certainly our US dollar outlook, again, it probably, as the first point of call, is a little bit more clouded than that of the Australian dollar. We have already witnessed sustained strength in the US dollar. It has moved so far, so quickly. And again, this has really been propelled, as I mentioned, by the mandate delivered by the US Federal Reserve. Whilst I say the US dollar outlook is I suppose, far from cemented, with our baseline expectation being that its strength will continue, I think in throwing caution to the wind, there is an acknowledgement that I suppose there are some risks oscillating in the background. And I think those risks are probably threefold. The first of which speaks to a US stock market, which is, I suppose, through a lot of lenses, overheated. I think we definitely have seen a classic side effect of overstimulation, in that if you were to look to view at, I suppose, valuations or share prices or even an index fund or the S&P 500, whatever indicator of value that you look at, it hasn't necessarily been supported by underlying earnings growth. And the analogy we like to use is that in a low interest rate environment, it's simply like putting a plug in a bath, turning the tap on and seeing the duck rise to the top. So in that, I suppose, anecdote, we will see a disconnect between where something is being valued at and where earnings are actually originating out of. The second risk, I suppose, speaks to the US twin deficits and the fact that the current account or fiscal situation in the US can be deemed chronic. Then I suppose the third pillar, again, this speaks back to Donald Trump and the fact that trade-related dialogue is certainly dominating headlines today. Fears over ongoing protectionism obviously will hurt economic sentiment, and this will obviously keep inflation high. So with all of that said, I think from an economic perspective, what is going to drive appetite for the US dollar is going to be what's coming out of the US Federal Reserve. But there are certainly things in the background which we are, I suppose, focusing our attentions on, and certainly acknowledging that there are risks to its outlook. Now, again, changing tack altogether, we've touched on, I suppose, OFX as well here, and again, to some extent, my conversations today have been centred around the Australian dollar and the US dollar. I'm certainly conscious that a lot of our audience today do operate in, I suppose, less mature markets, less developed markets, and this also speaks to, I suppose, some of our observations within the emerging and developing market space. And I think what can be summed up across that emerging market space is the environment is challenging. All of those markets, again, they are going to be influenced by things like a US and trade debate, which is showing no signs of ending anytime soon. We have NAFTA trade negotiations, again, which are ongoing. We have politics in Europe, which are very much on shaky ground. And still we have rising US yields. And finally, there are elections across a lot of key jurisdictions, which will certainly potentially take its toll. And we did see some recent flare-ups, of course, in Turkey off the back of signs of political instability. So it's a challenging environment across that sphere. But I suppose, again, in moving past my market view, I think that there are some payment considerations which I want to touch on just now. One of the reasons now that we speak so regularly about the US dollar is it still accounts for 90% of all daily FX transactions. And I think what is probably underestimated from an exporting point of view is that a lot of the markets, businesses that are looking to access, actually don't have freely exchangeable and accessible foreign exchange entry points. So what I mean by that is that you could look at the 12 or 10, let's say G10 currencies and all the major currency pairs. They are freely exchangeable against each other. We could do a Kiwi US, for example, a US Kiwi. It is a very simple transaction. That simplicity isn't necessarily evidence across a lot of the exotic or emerging pairs. Now, OFX, whilst we offer 55 currency sell options, again, there are some real limitations in looking to repatriate localized currencies in localized markets. So when transacting in US dollars, again, the benefits are vast and the settlement routes, they're very transparent, prices are sharp and the products are accessible. So all of these pieces basically speaks to reduction in costs and reduction in risks when transacting across borders. In representing such a broad customer base who, again, they do operate in the smallest nooks of this globalized world, I think, key areas of due diligence really do speak to 4 items that I've put down here, and that is firstly currency corridors. And again, a lot of customers will run into limited buy and sell options. It's very easy to make payments, for example, into North Korea. It's very easy to make payments into Malaysia, into Korean won, into Chinese yuan. But of course, there are enhanced complexities in repatriating monies out of those jurisdictions. In regards to the prices on offer as well, it isn't a liquid, matured, or highly tapped into market. And as a result, you will, I suppose, run into some additional expenses along the way. Something that we are passionate about and we speak regularly to is, of course, our product mix. And this topic will be touched more intimately during later webinars, but certainly the products which are deployed will be very much supportive of risk management. And as Phil mentioned, it is something which is probably underestimated in regards to the value it can deliver. So hedging constraints really is a fact, or a matter of fact, that again, when you are operating in these exotic marketplaces, the only real FX product on offer is a simple spot payment. You can buy and sell and potentially only on one side of the market. And finally, regulation. This is no different to the regulations in regards to accessing new marketplaces. Whilst a provider like OFX might be able to, I suppose, buy a currency, make the payment, it could leave our ecosystem. There are lots of constraints in regards to the ultimate delivery, the ultimate access, and the ultimate recipient receiving and having cleared funds on their end. These are all things which we get regular exposure to and we can speak to more intimately offline, if you like. So in I suppose, wrapping things up, I've spoken at top level in regards to the themes, but I think if I was to, in a somewhat unsubjective manner, I suppose, speak to OFX's capability, I think in representing global businesses and global citizens, again, I think what is really, really important is that we are partnering with a business with global capability. So global capability, not only in regards to the people support and our service operating models in all of these localized markets, but certainly the breadth and depth in support of mass collection and mass payments. So where possible, obviously we make large-scale investments, ensuring that we have, I suppose, a very deep and embedded and well-trenched list of banking counterparts. So unlike a domestic business, for example, which will certainly make all payments in and out of Australia, out of localised domestic Australian accounts, our model is supported by banking relationships across all of our key geographies. So with all of that said, I am hopeful that you found what I've delivered over the last half an hour of some value. If there are some questions for the audience, Phil, I would welcome them. And if I'm not placed, and if they are too difficult, we can take them offline. But yeah, if there's anything I can speak to now, I'd welcome it.
Michael, thank you very much for that. That was a fantastic presentation, and you know, it's not easy to present, you know, some very complex issues in a digestible format, and I think you did that very well. So let's have a look at a couple of questions before we look at a few that have come in. I've just got one for you. Yeah, OFX is you know, won the BRW Fast 100. It's got a 5-star CanStar rating, and it's you know, got the Deloitte Technology Fast 500. But my question would be, why would you use OFX rather than one of the big 4 banks?
It's a good question. It's a one that we get regularly. I think the easiest way to answer that is that we specialise in foreign exchange. You know, the banks cover a broad range of products, a broad range of services. Essentially, they are still borrowers and lenders at the end of the day. And I think this is essentially what we do. We do it every day. And we are, I suppose, somewhat internally, I suppose, to a large extent at this stage, but we view ourselves very simply as a business which really, I suppose, focuses on the customer experience. And again, I don't think that's probably a dynamic which the banks have quite got down pat at this juncture.
Yeah. Thanks. Now, last night, the exchange rate dropped below 75 cents. You know, how does that impact the short-term picture?
Yeah, I think I don't think it changes a great deal. We saw a couple of dips below 75 the week prior to last week as well, and there's a fair bit of I suppose interest on the dip towards 75. So I think that's probably just a broader acknowledgement that I think we are going to see little flare-ups. I mean, what triggered that was more of a political move out of Spain. There's been some political moves out of Italy as well earlier in the week. So there are lots of geopolitical flare-ups which are going to lead to sell signs for the Aussie. Unfortunately, you know, it is a currency which still kind of sits at the mercy not only of flare-ups but, you know, risk concerns, and it does kind of get thrown around. And again, I think it's not necessarily something which is dictating our mindset this morning, but I still think, yes, there is an acknowledgement that the highs, you know, back up above that 76 and 76.5 are probably, you know, coming off the shelf now. Yeah.
Great answer, mate. Here's another one. Does OFX provide same-day delivery of payments to the overseas supplier?
It does in a lot of circumstances. It basically does depend, though, on which currencies and countries that we are making payments to and from. So I spoke to OFX having global capability, and if we were paying, let's say, an account where we have localized sourced accounts, then obviously the payment is made from a domestic account to a domestic account. There is no international or telegraphic transfer. So yes, the payment routes can be simplified and fastened as a result. So a lot of pairs, you know, it basically settlement times will spread between same day and up to 2 to 3 business days, again, just depending on the currency and the countries that we're speaking to.
Yep. You talked about pairing, which is a great term. A question that's just come is, can you transfer Australian dollars to Hong Kong dollars and then to US dollars?
We certainly can do that. I would probably like to understand, I suppose, the motivations or the conditions which would lead to essentially a double conversion. I think the optimal piece is an Aussie US leg, and yep. I suppose we just want to better understand how that HKD piece came into the picture. Yeah.
Okay. Well, look, we can have that person. If they send us an email, we will get them in contact with you after the webinar. I've got a question. Some of the exporters that we come across, aren't in the tens of millions, but rather the tens of thousands of dollars. At what level of transaction does it make it worthwhile to do Forex?
Yeah, I think in percentage terms, obviously the value is in most cases delivered at the lower end of the scale. So if you do have exporters who have a foreign exchange component in their business, which is between say $10,000 and $100,000, our expected savings there would be comfortably 2 to 3%. So again, on a annualized basis of a 3% saving on $100,000 worth of flow, it would be close to 3%. Now, that is going to be contingent on who their current or incompetent provider is. But certainly, the benefits of our pricing model is that we will establish, obviously, a benchmark. We will establish a transparent margin, which is super important. But furthermore as well, that margin can be applied against all payments, not simply a payment of, they might have a large order at the end of the month and a large collection a couple of months later. We will simply establish a margin. It is known, it's fixed, it's transparent, and it's delivered across, I suppose, the full tenor of the relationship.
Yeah. Here's a question from one of our members. My business, I do up to $10 million worth of transactions a year. What level of protection insurance can you offer me with those transactions?
Yeah, I think governance is something which we speak to quite regularly. I mean, even we had an Investor Day a couple of weeks ago, and our chairman provided an update just on this very subject. We definitely enforce a culture of transparency, trust, and again, candor with all of our customers and our investors. From a regulatory perspective as well, we are fully licensed. We have an Australian Financial Services license, which essentially puts us on the same footing in regards to the level of protection and assurance we can provide when benchmarked against the banks here in Australia. So we're audited, we're regulated, and not only that, we essentially operate a very low risk business model. So we don't offer any debt, or we don't have any debt. We have a very strong balance sheet. And again, the risks associated with what we do are extremely low.
Yeah. Look, I think probably one last question, and it's just regarding, possible global shocks. There's so much going on at the moment. I read today that George Soros says, there could be another major financial crisis. You talked about the Donald Trump era. Overnight, we've had the Italian government in crisis. We've got Brexit. Who the hell knows what China's doing? What percentage of customers do you think should effectively hedge? And the second part of that is, if a crisis occurs, how quickly can that impact currency?
So probably two legs to that question. The first one is, should customers hedge? I think the resounding answer is yes, they should. There's the old anecdote of saying, doing nothing is not risk management. So you don't necessarily need to be super active or super involved in hedging. It can be very simple. It can be self-taught. It can be, delivered through an online portal like our offering. But yet, absolutely, customers should hedge. And that doesn't need to sit on both extremes of the scale, being do nothing or do everything. It can basically about finding that middle ground and really just understanding what customers' objectives are when either collecting large-scale payments or making large-scale payments. There definitely needs to be a conservative risk mitigation hat which is put on when making these decisions. In regards to the note that you made, you are right. There is so much happening at the moment, and I think we're only now starting to. I know I spoke a lot about volatility, but with volatility comes a lot of price movement, a lot of price activity, and to your point, it is almost instantaneous. So one headline overnight can basically, it can manipulate a exchange rate by 1.5 to 2%. There is a real sense of, what I would probably say flotation in the market at the moment, in that it literally appears like on a daily basis or probably a weekly basis at the moment that, on a Monday, some will say politics don't matter, and on a Tuesday, they are front and centre. You'll have people that saying that there's, excessive inflation and then there's not enough inflation. It was strange. I mean, if we were to label that, hey, we're in a Donald Trump environment now, I think if you cast your eye back to November of last year, that the one thing everybody got wrong was Donald Trump gets in and the market's going to rally. So yes, it is super sensitive, it's super timely, and as we know, optics is everything, particularly in political spheres. So the outcomes of what transpires aren't necessarily linear, or I suppose known until after the event.
Yeah. Look, I've got one last question here, and it reads, I've got a staff member making a whole bunch of transactions overseas using his credit card, and we're receiving a whole bunch of small bank fees that when you accumulate them add up to a whole bunch of money. Can OFX deal with this issue?
We definitely can. So the issue with credit cards, and again transacting with a lot of domestic banks, is there's going to be a number of parties involved in a transaction. So that speaks to multiple fees being incurred along the way. For example, MasterCard may issue a fee to initiate the payment. There might be an intermediary bank. If you were, say, paying the United States, it would go from Australia via an intermediary or via a correspondent. So there's a fee taker or handler in the middle. And then again, upon receipt, the receiving party may well say, well, okay, in order for us to clear and make the payment and credit it to the ultimate beneficiary, we'll charge for that role as well. So, in that equation, we're talking, three little bites of the cherry, if you like. We can certainly provide advice in regards to how we can potentially route around them. And again, having accounts across the globe, it basically creates this piece where we can eliminate correspondence and intermediaries where we can. And certainly our fee structures, in the majority of cases, are close to zero anyway.
Right. Okay. Well, look, that's all we have time for today. I'd like to thank Michael very much for taking the time to present today, and I'd also like to thank everyone who's joined us for today's session. All recipients, registrants, will receive a copy of today's webinar recording, plus the presentation slides later this afternoon. And please stay tuned for future webinars in which OFX will dive deeper into topics such as, how to identify risk and mitigate those risks, which I think can really aid in understanding of the global payment and macroeconomic environments. To close, thanks for joining us today, and I look forward to welcoming you to another webinar in the near future. Cheers.